number of directors who are liable to retire by rotation would retire at every AGM. Now, uh, the recent amendment, which comes into effect from 14th of July 2023, at least once every 5 years, the shareholders will have to approve a person holding office for a period of 5 years or more. Because if you're going to be treating the person as non-retiring, whether you call it permanent or for a period of 5 years, you would need to place it for approval once in 5 years. This provision comes into effect from 31st of after 31st of March 2024, which means effective 1st of April 2024. And it also says that the first AGM to be held after 31st of March 2024 is the one at which you are required to consider. You can, of course, pass a resolution before that, but that's the maximum period that you get for getting approval of the shareholders, by virtue of which the person would be entitled to hold office for another 5 years, and then you would need to place. Does it mean that you need to change your articles? Answer is no. While the articles may say that the person is going to be a permanent director, you would need to keep on refreshing it every 5 years at least. However, this particular provision is not applicable to a managing director, a whole-time director. It also includes manager, but actually a manager is not on the board, so therefore this is not really relevant. And under Section 196 of the Companies Act, you necessarily need to appoint a manager for a period not exceeding 5 years only. Even in case of a profit-making company, if it's not profit-making, remuneration resolution will be valid only for 3 years, while with respect to the tenure, it could be for a period of 5 years. So these provisions, while they've said that they will come into effect, or rather the approval needs to be sought in the first AGM to be held after 31st of March 2024, there's no bar on the company applying for it, company placing it before the shareholders well before that. Section 180 of the Companies Act. As you know, under the Companies Act 1956, this sale, disposal of the undertaking, or substantial whole of the undertaking, or substantial part of the undertaking, required only an ordinary resolution under 56 Act. However, under Companies Act 2013, Section 180 requires a special resolution to be passed. As you're also aware, by virtue of the notification dated June 5th, 2015, this provision is not applicable to private companies. Of course, you can have listed companies which are private companies, and while Regulation 37 is not applicable presently to debt listed entities, one needs to be mindful of this provision, so that going forward, if at all there is some provision under which it becomes applicable, one would need to be careful about it. So, and I'm actually mentioning it because, as you know, with respect to schemes, even debt listed entities, there is a separate provision which has been introduced. So it may actually come through later, although presently, as we are speaking today, this is only applicable to equity listed companies, absolutely in sync with 180 presently. The moment it gets applicable to debt listed entities, while 180 may grant an exemption, here you will need to take approval. And what is important is it provides for majority of minority approval to be taken. The exemption which has been granted, or rather the carve out which has been made, is with respect to creation of security in favor of financial institutions, because as you know, going by the old case law which was decided by the Supreme Court in the case of Yellama Jute, even creation of a mortgage would also amount to a disposal, and therefore the carve out has been nicely provided, which says that if it is with respect to creation of security in favor of a financial institution or the debenture trustee, you don't require to take a special resolution in this case. All other cases which are outside a scheme will require approval. Now, actually, what has been brought in over here in Regulation 37B is that if you are disposing it of if you're creating a sale, disposal, or otherwise with respect to the undertaking or substantial part of the undertaking, you do require a special resolution under Companies Act. But here, under LODR, you would require a majority of minority approval also. The carve out one, as I said, is with respect to the debenture trustees and financial institutions. The other carve out is with respect to sale, transfer, or otherwise, which is made by the listed entity in favor of its wholly owned subsidiary. This, of course, is absolutely in sync with related party transaction provision under Regulation 23 also, because in case of RPTs, there's a carve out which says that if it's a transaction between the listed entity and its wholly owned subsidiary whose accounts are consolidated with the listed entity, you do not require approval, and the provisions of Regulation 23 are not applicable. Similarly, provisions of Regulation 37B will also not be applicable if it's a transaction between the listed entity and its wholly owned subsidiary whose accounts are consolidated along with that of the listed entity. However, in case the listed entity decides to reduce its shareholding in this wholly owned subsidiary, and the wholly owned subsidiary does not remain as a wholly owned subsidiary, approval of the shareholders will be required to be taken. Or a second scenario where the wholly owned subsidiary decides to transfer, alienate, sell, lease, or otherwise dispose of the undertaking or substantially the whole of the undertaking or any part thereof. What is important is or any part thereof has also been covered. In that case, approval of the shareholders of the listed entity will be required to be taken. What one needs to be extremely careful about and mindful of is there is no specific time frame given with respect to this disposal by the subsidiary. So what is like under the Income Tax Act, there is a time frame that is given. Here under LODR, there is no time frame that has been given. So one needs to be extremely careful and mindful of it. And the carve out overall, which is anyways there, is with respect to the schemes, which in any case would be covered under Regulation 37. Let's now move on to Regulation 30. Um, I don't think I would have the time to cover all the provisions, but I'm just going to do a bit of pick and choose. If you now move on to Regulation 30, all of us are very familiar with the materiality policy. And the materiality policy was governed principally by Regulation 30, Subregulation 4 of LODR, which it continues to be governed by. And in Regulation 30, Subregulation 4, there is a materiality threshold which has also been introduced in terms of quantitative terms. Now, earlier it was left to the discretion of the company to determine as to what would amount to an event which is material or an information which is material, which was to be governed by the materiality policy. Schedule 3 had two parts. Schedule 3 had two paragraphs, rather, I would say, para A and para B under Part A. Equity listed companies are governed by Schedule 3, Part A. So, para A and para B. Para A comprises of items which require disclosure without applying the test of materiality. And therefore, it is a complete set of line items which require absolute compliance. Para B was one which was to be disclosed based on the touchstone of materiality and which was to be governed by the materiality policy. So each company had the flexibility of determining whether to disclose an event or information covered in para B of Part A of Schedule 3. Now, going by the amendment, the thresholds for disclosure have been clearly laid down, which is 2%, 2%, 5%. Let's just spend a minute on these three. 2% of annual consolidated turnover of the listed entity as per the last audited financial statements would be taken as the threshold, which means if an event or information is likely to exceed this figure or is likely to have an impact exceeding this figure of 2% of turnover of the 2% of the consolidated turnover of the listed entity, then it requires disclosure now from July 14, 2023. The second threshold is 2% of the consolidated net worth of the listed entity. The third threshold is 5% of the absolute value of average net profits of the listed entity for the last 3 years. Consolidated net profits will need to be considered. The word absolute value has also been brought in. Let me once again repeat, 5% of the absolute value of average net profits of the listed entity, consolidated net profits of the listed entity for the last 3 years. What is this absolute value here? In fact, this is a question which comes up pretty often. Now here, let's assume the company has had a net profit of 12% of turnover in year 1, 10% of turnover in year 2, 11% of turnover in year 3. If you were to take 12, 10, 11, you get 11% of turnover, which becomes your net profit. Is it 5% of this 11% of your consolidated turnover, which would be considered as a threshold? Answer is no. What has now been provided is 5% of the absolute value of average consolidated net profits for the last 3 years. This would mean you need to ascertain 5% of net profit of year 1 in absolute terms as rupees X. Similarly, the second year rupees Y, third year rupees Z, and do an average of X plus Y plus Z by 3, and that would be taken as the threshold. The absolute value is the threshold, which would be ascertained in this manner, and that is the reason the term absolute value has been used in the context of average net profits and not in the context of turnover or net worth. Suffice it to say that once you have found this threshold, you will need to see as to whether any of the items covered in para B of Schedule 3 Part A require disclosure or not. Just to give a simple example, it could be with respect to addition of capacity. If you are adding capacity to your manufacturing facility, what is the likely impact or what is the likely investment that you have made in doing this will need to be considered, and based on that, your disclosure will have to be made. Let's say, for example, you may be availing of a facility from a bank, and it may not actually be falling under para A, but it may be one which exceeds this limit, and therefore the agreement that you are entering into with respect to loan syndication may become important and may require disclosure. There's another question which begs an answer. What if the company is a loss-making company? Does it mean every transaction will merit a disclosure? Every transaction which is covered in para B will certainly require disclosure. Even earlier, there was this provision which said that if it covers any of the transactions or items covered in Schedule 3 Part A, para A or para B, wherever applicable, the company shall first disclose to the stock exchange. Now, I'm just mentioning this first disclose, and I'm emphasizing on this because even with respect to notice of the AGM, you normally would disclose it to the stock exchange before dispatching it to the shareholders, because the term used is first disclose, which basically means anything which requires disclosure, you make it generally available by uploading it on the stock exchange site. Thereafter, it goes to the shareholders or the investors, as the case may be, or even to the media, because if at all it is something where you're making a media release and it requires disclosure, this is the way it will have to be disclosed. Um, Added to this, there's also another point, which is amendment to PIT regulations, which is of course yet to be approved by SEBI. Or for that matter, it has not yet come up before the SEBI board. But what is important is the original UPSI definition, which was originally there, which was subsequently amended, which is inclusion of Regulation 30 disclosures. Now, Regulation 30, as we've been just analyzing and examining, comprises of certain items which are per se said to be one meriting disclosure, that is para A disclosures. It may not actually be an unpublished price sensitive information technically because it may not have a material impact on the price. So, of course, this is something which one needs to see as to how it pans out. But suffice it to say that we need to be mindful and we need to watch this. Coming back to Regulation 30, um, presently, there may have been certain events which may not have been disclosed because they are not material, because they fall under para B and they are not material presently. However, effective 14th of July 2023, if there is any event which has partially happened earlier and is a continuing one, then you will need to make a disclosure within 30 days of coming into effect of the provisions of Regulation 30, amended Regulation 30. Now, this would mean that if it is completely a concluded transaction, you don't need to make a disclosure. However, if it is a continuing one, it is one which will require disclosure uh, because the added new definition of Regulation 30 disclosure, which basically is triggered by the 2 to 5 threshold, as well as by the new additions which have been made to para B. For example, let's assume there is a proceeding. Let's assume there is a litigation which is pending before the authorities, and it exceeds the threshold limits. You will need to make a disclosure once the amended provisions become effective. So this is something where a laundry list of all these items will need to be made so as to be ready and well geared. Going back to materiality policy, in the materiality policy, there is one major change which has been made, which is the materiality policy should be one which provides assistance to the employees of the company so as to escalate the issues to the key managerial personnel for the KMP to take necessary action as per Regulation 30, Sub-Regulation 5, in terms of determining whether it requires a disclosure or not, which means the onus gets shifted on to the compliance officer to ensure that the materiality policy is not only drafted in a proper manner, not only implemented in a proper manner, but more importantly, to ensure that there is sufficient socialization and awareness created in the organization so as to ensure that all across the organization, wherever there is a possibility of any person having to intimate the key managerial personnel, such a person is aware of this. Let me give an example. The event may occur anywhere in the company. For example, it may be with respect to a transaction which may be happening in treasury, or it may be with respect to something which is emanating in the manufacturing side, or even it could be R&D of the company. What is important is, have you created that awareness for the person working at that end to contact the concerned persons who would then be determining whether to make a disclosure or not? What is the materiality threshold for the company concerned? Have all the persons in those respective departments, which possibly can have a touch point of escalation, been made aware of this? will become important. People in large organizations keep changing. So you will need to have these awareness programs run on virtually a continuous basis. Better still, ensure it is covered clearly in the code of conduct, which is signed off by a larger group of persons so that even a new person who joins the organization gets it in his induction pack, and an existing employee keeps refreshing it time and again. This is something which is very important because the materiality policy would have been approved by the board of directors of each equity listed company in the past. You will need to ensure that you place this before the board at the next board meeting to be held. Uh, do you need to pass a circular resolution before 14th of July? I would say it's not actually required. Even if you do it at the next meeting, it should be sufficient because just for this one would know, and it actually is one which would require a bit of discussion also. So therefore, the time that you get in the next few days, you need to ensure, which is not really much. We are already on the 1st of July. So we need to ensure that this particular materiality policy is properly worked on. Awareness modules are created. There is sufficient socialization all across the organization. And to be on the safer side, I would say rather than picking and choosing the employees in the departments, make it clearly known across the organization. So except of course where you know that there will be absolutely no touch point and possibly it will create more confusion, those could be avoided, but all others in every managerial position could be informed of this. um, you also, if you're otherwise looking at it in terms of who to create awareness, you will need to create a complete list of relevant employees as to how exactly you would be doing. Most organizations would have media policy. So along with the media policy, one would need to inculcate a discipline with respect to materiality policy also, because there's another provision which says that if there is any communication made by the KMP, directors, promoters, or any senior personnel of the senior management personnel of the listed entity concerned, then even that requires disclosure. It will be considered as something which has emanated from the company and it will need to be intimated to the stock exchanges. So therefore, this is also another provision where along with the media policy, this will need to be very clearly communicated. The department which handles all queries from the press or even interactions will need to be very clearly intimated of this. For that matter, talking of Regulation 30 with respect to investor meets, there's a specific provision which requires prior intimation of not less than 2 working days, excluding the date of meeting and the date of intimation. So this is also one which will require compliance going forward. Um, so any item which is covered in para B, one will need to see whether the touchstone of thresholds 2 to 5 are getting attracted or not. Even if 2 to 5 is not initially attracted, if there is an incremental transaction, you will once again need to see. So suffice it to say that under Regulation 30, you will need to see whether the event or information is one which is covered in para A. If it's covered in para A, no thresholds, nothing to be applied, you need to intimate. Second, even if it is not covered in para A, if it is covered in para B, you would need to see whether the thresholds are getting attracted. If it is neither covered in para A nor covered in para B, the board would have the liberty of considering whether it's something which requires disclosure or not, whether in their opinion they feel it is material. The other important point is if you've once made a disclosure, updates will need to be given. Now, this is another interesting point where the omission to give such an update is likely to result in a gap in information. So, which means if you have given a disclosure earlier, you will need to update it as you go along. Of course, if you refer to Schedule 3, there is guidance given with respect to acquisition. Acquisition, as you know, until the new change comes into effect, which is 14 July, uh, acquisition was only with respect to anything which you acquire And of course, it also covered sale or disposal of an undertaking or a division or a subsidiary. But with respect to other associates and all were not covered, which has now been included, which basically means if you're holding shares in an associate, you certainly are holding shares in an associate, and your shareholding changes by 2%, it will require disclosure. So the change has been defined as one which results in a change of 2% from your last disclosure. Remember, this is very similar to what was originally there in SAST, and here it is this 2%. Either ways, it's what is referred to as change. So sale, purchase, whatever, this will require disclosure. What's also interesting is it covers um, acquisition, directly, indirectly, which was always there, in a company incorporated or proposed to be incorporated, or rather existing or proposed to be incorporated, also requires disclosure. So you may be forming a joint venture and you are then agreeing to invest in that entity. An investment agreement will also require disclosure. Let me pause over here for 5 minutes and take one or two questions before I take it forward. Is that okay, Mr. Anand Subramanian?
Yeah, it's. I think
Yeah.
we do need a break.
Sure.
In terms of, we'll see if there are any questions on the matters covered till now. Otherwise, we'll move ahead.
That's right. Yeah.
It is too much daunting. Yes, there is a question here which has come, whether losses would be reduced or arithmetically added. Mr. A. Shekhar, practicing company secretary.
So I don't think losses would be reduced because in the threshold calculation there is no, actually, 5% of the, no, it would be reduced because it says 5% of the average of absolute value of profit or loss as per the last 3 years. So let's assume first year you've made a profit, second year you've made a loss. So since it very clearly covers or loss after tax, you would be able to take the absolute value and it would be reduced. In my personal view, it would be reduced.
Okay.
Can I come in, sir? Can I, with your permission, come in?
Yeah, please.
Go ahead, Shekhar.
No, in fact, I happened to read the meaning of absolute value, which is why I posed this question.
Sure.
Absolute value means there is something in mathematics which is called modulus, where what happens is that suppose there is a number 20 and there is a number 5, minus 5. The sign is ignored and it is added. See, loss also has an impact on materiality. So now whether the regulator intended it to be added or reduced, that is the question. In that context, I posed this.
Yeah. So, Shekhar, I agree with the point that you brought out, but in my opinion, if the term or loss after tax were not written over here, because what they are very clear is it's going to be PAT. PAT can be positive or negative. Now, when they're saying absolute value, yes, I agree it is the number, but when you're referring to loss is also one which needs to be considered, because if I were to ignore that, let's assume 3 years you've made losses, an absolute value cannot just be the number, and hence I would say loss, if it is a loss, your average will just come to zero, which means everything will require disclosure. But absolute value, when you're calculating with 2 years of profit and 1 year of loss, let's say for example, few of the industries due to the pandemic did have a bad year, and as we know, few sectors did have losses in 2021, while 2021 22 and 22 23 may have been very profitable. The first year of loss will also get reduced while reckoning the 5%.
However, what happens is that if we look at the substance of materiality in a particular year, if there are very big losses, then the materiality in substance is, it becomes material in substance, which is why my query. But I don't know what is the intention of the regulator. That is more important. But in sum and substance, I think even losses will be material. That is my
Yeah.
conservative view.
No, I agree. And I think it's a very good point that you've raised. So let's assume year one, you have losses, year two, you have profit, year three, you have profits. If you were to reduce the losses, your 5% of average net profit goes down further. So therefore, it is in the interest of the provision on a very, very conservative basis where you would end up disclosing. But if this was not to be reduced, your profits would have been higher, and therefore the threshold would have been higher. So therefore, I would say it would have to be reduced.
Any other question?
Sir, I had one question. Portfolio from LFT.
Sorry, your voice is not very audible, please.
Who is that? Who is this?
Orville, your voice is not audible.
Hello. Yeah, Vishwanathan, I'm audible?
Yeah, now you are audible.
Yeah. So, ma'am, I just had one question on the rating bit, which you were saying that, every rating has to be disclosed to the exchange.
Right.
So, in case of commercial papers, the rating is supposed to be not older than 1 month when you apply for listing. So, in that case, whenever there is a reaffirmed letter or possibly a revised letter with a revised date, which is issued, that has also to be intimated or that can be excluded?
The only saving grace is that commercial paper is not a security covered under LODR because it very clearly excludes money market instruments, and commercial paper is a money market instrument under the Reserve Bank of India Act of 1934, covered under Chapter 3. Hence, with respect to commercial paper, including ratings thereof, you do not have to make any disclosure under LODR.
Understood.
Although at the time of listing, since they are covered under Chapter 7 of ILNCS, you would have to give it. Actually, if you recollect, October 22nd, 2019 circular was actually directing the banks and mutual funds to invest only if commercial paper was listed, which meant that there was no bar on listed entities, or rather, there was no bar on entities issuing unlisted commercial paper. This is because with respect to money market instruments, the only area where SEBI regulates is with respect to listing. And this has been done indirectly in the sense that the investors in commercial paper have an obligation to ensure that they invest only in this manner. So coming back to your question, it does not require any disclosure under LODR, and therefore this rating does not require disclosure. However, if you have 3 rating agencies for, let's say, 4 series of debentures, you actually are going to be monitoring 12 disclosures to the stock exchange, because each ISIN will have a separate confirmation of rating. You probably may get one single confirmation, which is very good. So at least ensure that you get single confirmation from the rating agencies to the extent possible, so as to avoid multiplicity of disclosures.
Thank you, ma'am. Noted. Thank you.
Right.
There is one more query.
Can the approval for materiality be taken in a board meeting prior to 14 July if there is a board meeting which has been scheduled before 14 July?
Please do. Because in anticipation of a certain law, if you are taking approval, it's absolutely fine, and that's a good practice. Go ahead.
And what are the special rights under Regulation 31A? What are they referring to?
So the special rights could be, okay, let me now move on to the agreements. It could be with respect to reserved powers. It could be with respect to voting in tandem. It could be with respect, typically you would have with respect to reserved powers, there are certain rights. It could be with respect to certain rights of preemption, ROFR, tag along, drag along, if at all one of those persons were to sell, all these, there could be several of these, all these will all get covered under special rights. Typically voting in tandem, as I was mentioning. So all these, what is important is agreements binding on listed entities. Now, when you refer to agreements binding on listed entities, they would fall under two baskets. One, agreements which may have been executed earlier, or agreements which are yet to be executed. If they're yet to be executed, you know as to how you're required to disclose, because you are required to make the main terms clearly known to the stock exchange, as well as place it on the website of the company. In fact, post 14th of July, if the annual report, I mean, post 14th of July, the annual report of the company is required to give a link where the terms and conditions of such agreements have been placed, and also the list of such agreements will also need to be disclosed. Now, what exactly are we referring to in terms of agreements? Let me take it to its brass tacks. Who could be a party to such an agreement? There are 7 categories of persons who've been listed in this. It could be shareholders of a entity. It could be promoters, promoter group entities, related parties, directors, KMP, or employees. So in generic terms, you've covered a very large set of persons who could be a party to an agreement. Now, who are these? These 7 categories may be of the listed entity concerned, or its holding company, or its subsidiary company, or its associate company. So all these 7 categories of persons of these 4 class of companies, with of course the listed entity at the heart of the issue, which may impact the management or control, or place a management or control of the listed entity, or may place a restriction on the listed entity, or may place a liability on the listed entity. Mind you, this is very broad. Restriction. Now, when you say restriction, uh, just to give an example, I referred to reserved powers. That could be said to be a restriction, or it could be in the context of, let's say, ROFR, where there is a restriction, or maybe creation of encumbrance, or any of these could all be treated as restrictions. Or liability. Liability could be one which is very, very broad. And what is the quantum of liability? It's something which will once again have to be tested in the context of the provision. Now, since it falls in 5A of Schedule 3, Part A, Para A, liability here could be anything. You would require disclosure, and such an agreement will need to be disclosed to the shareholders, and you will need to prepare a complete list of such agreements. Now, here, the parties to the agreement may have entered into it in their individual capacity. The listed entity may be a party to such an agreement, may not be a party to such an agreement. Even then, they need to intimate the company, and the company needs to intimate the stock exchange of all such agreements. Now, once again, you'll need to put a proper process put in place, to have a proper process and a communication mechanism put in place to ensure that you capture all this. In fact, these 7 categories of persons, with respect to the 4 entities, you will need to have a very detailed list. I mean, while I said 7 categories of persons, even promoter group entities. Now, promoter group entities, one would go based on ICDR definition, which is what has been referred to even in LODR. Typically, you would have these persons listed in your shareholding pattern also. So, because their right with respect to shareholding in the company is what is referred to. So, therefore, you would, based on this, create a complete list and ensure that you create an awareness program for all these categories of persons, so as to ensure that you are kept informed. Now, it could even be with respect to any person who is in the subsidiary. and which can impact the listed entity. Holding company, subsidiary, which can impact the listed entity. So what needs to be seen is what is the content of the agreement, and is there an impact on the listed entity? Is it likely to place a restriction? Is it likely to place a liability? If yes, disclosure. So it's a very, very heavy provision which needs a proper analysis, understanding, compilation, and of course, compliance, which would mean disclosure. These are agreements which are binding on the listed entity. Since this is a very, very important provision, I'm going to take one more provision and then I'll actually take questions. Special rights granted to the shareholders of the listed entity. So if there are any special rights which have been granted, once again, when you refer to special rights, let me give a simple example. Let's assume there is a private equity which has invested in a company. Subsequently, the company goes for a public issue. The private equity continues to hold shares, and of course, their original agreements are also valid. So, therefore, with respect to operations, they may have some special rights. With respect to assertive rights, they may have certain special rights, as the case may be. All those will require approval of the shareholders once in 5 years. Let me stop over here, take questions. With respect to agreements in particular.
There is no specific question relating to agreement, but there's a general question as to, there is a mention in the regulations in the as to approval of shareholders in general meeting. So does it include postal ballot also?
Yes, of course, it will include postal ballot also, because the term general meeting has been used generally, but postal ballot is definitely covered.
Another question is relating to what shall be the time limit for disclosures to be made under para A of part A of schedule 3, other than that time mentioned for outcome of board meetings.
So now we have 3 time limits. Earlier, of course, it was only 2. 30 minutes and 24 hours was under the, or I would say, is the time limit presently. But come 14th of July, it's going to be 30 minutes, 12 hours, and 24 hours. 30 minutes, wherever it very clearly provides for 30 minutes. 12 hours, where the event or information is arising within the company, and 24 hours in all other cases. Now, arising within the company would mean where the company is a party, or where it has been signed by any person on behalf of, or rather representing, the interests of the company, which effectively would mean that if the company is a party to the transaction, 12 hours, all other cases 24 hours. There could also be another way of looking at it, where the where let's say the promoter of the company is a party and the company is not a party. One would definitely say that the listed entity is not aware of it until it gets the information. So in such cases, 24 hours would be the reasonable way to interpret it. Yes, please, Mr. Kamlesh.
Hi, madam. In the SEBI regulation for acquisition purposes, there is a prescribed format to disclose as per 9 September 2015 SEBI notification for acquisition purposes. Now, as per the new regulations, they also mention that there are certain agreements which creating impact on the change in management control of the listed entity or impose restrictions or liability upon the listed entity, that also needs to be disclosed. Suppose in an acquisition, there are say certain restrictions if a company has agreed, say providing parent undertaking, parent guarantee, or any restriction like change in voting rights or percentage of stake in future upon change in law. So such parameters are not currently there in the current acquisition format. So does it require to be specifically disclosed in the format if company is signing any acquisition agreement?
So as you know, this provision comes into effect only from 14th of July, and I'm sure the XBRL filing As you know, it's already become fairly complex. The number of headings one needs to choose and how exactly you go about it. These additional headings will automatically get covered. The 9th September circular will also get elaborated with respect to the new areas, which I'm sure they would bring in further disclosures to be made under each of these. So as we speak today, yes, it has not been amended in the XBRL format, but I'm reasonably sure by then they would do it.
Understood, ma'am. And ma'am, generally, a listed entity, while doing any such transaction, already seek their board approval. But such these are certain additional events which triggers the disclosure. So does it also require to be specifically approved by the board? We are including in the disclosure?
That's a good question that you've asked. See, board approval is only required where the board needs to approve something. Where the board is not required to approve, why should you go to the board? Why are you placing a further restriction on yourself where neither the law requires you to take board approval, nor the memorandum of articles of association of the company require you to take, nor any internal schedule of authority requires you to take board approval? So in which case, you don't need to go to the board. However, disclosure will be required to be made. Now, probably your question is arising from the fact that in the circular of 9th September, it says within 24 hours of approval by the board. Now, where it does not require approval of the board, it is 24 hours of the transaction or 12 hours going forward, as the case may be. If it is one which is emanating from within the organization, 12 hours.
Understood.
So you don't need to go to the board where it is not otherwise required.
Understood.
But disclosure, absolutely imperative.
Got it. Got it. And another question, ma'am, like in the regulation, new regulation for shareholders requirement at several places, the terminology used is in general meeting. Does it mean mandatorily it has to be sought only through EGM, AGM, and shareholders of stock postal ballot route is not available?
No, which is exactly what I just covered 5 minutes ago. Postal ballot is very much permitted. No problem.
Okay, ma'am. Thank you.
Because postal ballot being permitted is something which is very clearly provided in Companies Act itself.
Yes, ma'am. Okay.
Yeah.
Thank you, ma'am.
Ma'am, there's a query from a participant asking clause 20 of para A of part A requires penalties levied to be disclosed. So are we required to even disclose minor penalties of few thousand rupees?
So since it is in para A, answer
Para
is
A of part
yes. Yes, para A of part A, it's one where you do not apply the threshold of materiality. Unfortunately, yes.
Okay. There is a hand which has been raised by a number. I am not able to get her. Can you speak? 2004915.
Sorry. Hi, Vishwanathan Urvelia, sorry.
Okay.
Just one question on the Part B disclosures with respect to bagging or receipt of orders. So now where the provision says that if there is a continuing disclosure which we have to make because of the water value crossing that materiality as per the new calculation, we have to disclose. Would it apply for future orders as well? Like for example, if I have received an order for X amount today and there is a change of scope or the customer has given me some additional work because of which the value of the contract exceeds the materiality threshold as per the 2 or 5% at a later point in time, maybe around after 1 year or 1.5 years, am I still supposed to disclose at that point of time?
So what you need to see is this continuing contracts. So where you've already backed an order which did not require disclosure, you've started giving effect to it. So there is nothing that you need to do today. But while you are completing this, there is a new agreement which comes up. Okay? There are two ways of looking at it. One, if in the addendum you end up writing the total value of the contract, thereby exceeding this 2 to 5 threshold, do you require disclosure? Answer is yes. But if you were to only refer to it as an addendum for X amount without referring to the original contract, where by virtue of the original contract, you're getting work which is not breaching the threshold, you don't need to give it. But typically for orders, if you have more or less completed, I think your marketing team would be more keen on disclosure on these matters. My suggestion would be, when in doubt, disclose. The only thing is, if you say it's a continuing contract and you're giving effect to it, earlier it did not require disclosure, now it requires disclosure. Is it only requiring disclosure because there is an added 20 crores added to it? Or was it always continuing? I mean, how do you make that disclosure? Is it an update? Is it a new contract? Will be a question which will actually come up.
And that was on the piece of the continuing part. But suppose if there is a situation, similar situation, after the regulations coming into effect, effective 14th of July, where I receive a contract which is less than the threshold, and this situation arises again. So would we apply the same logic?
So since the contract value was less than 225, you would not have disclosed initially. Subsequently, by virtue of an added value, the threshold increases, and therefore by virtue of by virtue of an added value to the contract, if the threshold is getting exceeded, you would be disclosing it at that juncture. Let me give an example of PIT regulations where it refers to 10 lakh per quarter. So only when you exceed that particular limit would you be making a disclosure. So it's not when you're initially doing where it does not exceed the limit. Subsequently, if it is exceeding, that's when you would be giving the disclosure, which is absolutely fine.
Noted. Thank you.
Yeah, there is a query from Ashish Karekar. Clause 8 of para B is changed to pendency of any litigation or disputes instead of litigation stroke dispute. Does it mean all litigation pending on 14th July are to be disclosed?
So all litigations which are pending as on 14th of July, which exceed the threshold, will need to be compiled to see the materiality, and if they are material, yes, you will need to disclose. What you need to see is whether they are material or not. Say, for example, if you have only provided if you have only shown it as a contingent liability and the probability is very, very low. If it is from a regulator, I would say go ahead and disclose. Now, what's important is pendency of such litigations and proceedings may also include revenue matters. So that's something which is going to be a debatable point.
Yeah, there is one question from S. Gaur. What shall be the time limit for disclosing the subsisting agreement under clause 5A? Does all the subsisting agreement which seems to have impact needed to be disclosed exists prior to such amendment?
Yeah, they have said that they would come back as to the timeline as well as the format. So we'll have to just wait. But you should compile it because it can come up anytime. I'm reasonably sure there would be a circular on this. So there was one query which I just read on regulation 30, sub-regulation 11.
Yeah.
In fact, owing to paucity of time, I had not covered it, but I would just very briefly touch upon it. Effective 1st of October 2023, the top 100 companies, and from 1st of April 2024, top 250 companies based on market capitalization will have to confirm or deny. And if they confirm, they will have to also give this details as to the stage in which the particular transaction is with respect to any rumor which is reported in mainstream media, and mainstream media is now a defined term with respect to specific events which are reported in that. Now, mainstream media, the way it's been defined, it says newspapers which are registered with Registrar of Newspapers in India. Now, RNI is an authority which has been constituted under the Press and Registration of Books Act of 1967, and they register titles. So there's something called a March 1 declaration, which all the publishers of newspapers are required to publish in their respective newspapers, or dailies as they are commonly referred to. And this particular provision is mainly to ensure that the publisher and printer are made responsible for any matter which is published in the papers. But anyways, in the context of LODR, what they have now said is, if it is a paper which is registered with RNI, then it will be considered as mainstream media. Going by Google search, it's much more than 1 lakh newspapers. But what is important is they've also said something which is circulating among the investing public. But I would not really put it to too much of analysis. Anything which is published, which is reasonably expected to be seen by people, I think the top 100 companies now have an additional responsibility to confirm or deny any news matter which is of specific event concerning the company.
Most of our friends will know there's an esteemed shareholder called Anil Kumar Poddar from Calcutta. He also owns a newspaper.
Yes. One would need to see whether that is covered in RNI. I'm sure, the easiest way to see whether it is registered with RNI or not is, of course, this is not a foolproof method. One will have to go to the RNI site, but the easiest way to see is every paper would have a print line, which would give the name of the printer, publisher. The second is it will have issue number, volume number, and it's based on the number of issues released. Volume number would also show the number of years post the registration, and then based on that, just check the RNI record. I'm sure RNI will also come up with a complete list showing whether it is registered or not registered. And in the print line, you're supposed to give the RNI registration number.
The third part, it talks about publications abroad. Now, how do we deal with it?
Yeah, publication abroad, which is normally circulated in India, is the common way in which it will be interpreted. But this is not an interpretation which is open to analysis. I think publication abroad, I would say all the major newspapers will have to be considered. It's a tall task, but yes, that's what needs to be seen.
There's a hand lifted by L&T. Shivaram? Or Subodh?
No, Savithri, this is Shivaram here.
Yes, Shivaram.
Again, coming back to that 3011, where you mentioned about what comes under the mainstream media, but which is not general in nature. What do you, that not general in nature is not coming out very clear. Does it mean that it is something which you have already published and somebody is making a derivative out of what you have published? Or is it something like a new technology or something has come and somebody gives an opinion on that which this company also is involved?
So not general in nature would mean something which is, which is, let's say, for example, the media has reported some event where the company was a sponsor, for example. That would be considered as something which is very general in nature. It is not about something specific. It is not about, an acquisition or let's say, for example, let me give an example of a company which is not really doing too well, and the media report says that the rating report is likely to be released soon, which would show that the debentures are not capable of being serviced very well. Okay, this company is going to default. Okay, this would be specific because there'll be a run on the money, then it's going to affect the investors. But if it is something about a company, let's say, let me take a very mundane example, company looking for space and is likely to acquire space in
the
BKC.
Recording has stopped.
So those kind of ones would be considered as too generic and would not require any clarification.
No, thanks, Savithri. We are attending from a conference room. We are 11 of us here actually, company secretaries. So a fantastic presentation. Yeah.
Thank you very much. Thank you, Shivram. Thank you very much. Um, I just heard saying that the recording has stopped. Of course, I do have a lot of other points, cyber incidents, which are going to be covered, cyber incidents and cyber breach. I think there's a clear distinction between the two, but owing to paucity of time, we could do that later. For example, even with respect to director's appointment, where there's a very thin line and a correct interpretation, I would say, where they've clarified saying that if a director is likely to complete his tenure, an independent director is likely to complete his tenure, you cannot get benefit of another 3 months. So only in case of events which are beyond the control or which are not foreseeable when you get the 3 month time gap. Appointment of compliance officer, interim appointments not being recognized unless it is an appointment by following the proper process. Now, this is one which is very interesting because proper process would here mean if it's covered under section 203, have you appointed the person by passing a resolution at a meeting of the board of directors? As you know, under 203, let's say, for example, if the CFO's position, you have appointed someone as an interim CFO, you certainly can appoint a person as an interim CFO, provided you've passed a resolution at a board meeting where the responsibilities of CFO have also been cast on this person. It cannot just be for the purpose of signing the papers, it has to be with the responsibilities. Interestingly, Regulation 6 with respect to compliance officer under LODR, the person need not be the company secretary of the company. It just needs to be a person who's qualified as a company secretary. So there, since it is, if it is, let's say, a company secretary, but not the company secretary of the company, you need not pass a board resolution for such an appointment. It could be just appointment by passing a resolution by circulation. You need to have this person appointed by a resolution passed by the board because the board should have made him a compliance officer, but it need not be passed at a meeting of the board if it is not the company secretary who's discharging this function. There are several more nuances, but I think we could have more detailed discussion in future too. Yeah. Over to you, Mr. Hansen.
There's a query from
Mr. Harish Ved.
Sure, Mr. Ved, good morning, please.
Can you unmute yourself and speak, sir? Harish, sir? Yeah.
Morning, Savithri, how are you?
I'm wonderful. Thank you very much.
Thank you very much. Excellent presentation, I must say. I'm extremely sorry. There's some internet problem here. I don't know whether you can hear me or not.
I can hear you very clearly, although I'm not able to see you, but I can hear you very clearly. Please go ahead.
Maybe I will join you a little later. Please carry on.
You go ahead. I think we should go ahead, Savithri, because you have, as we had discussed, you'll complete. Even this presentation is quite daunting.
Yeah, that's very true. So actually, coming back to cyber incidents and cyber breach. Now, if there is an incident of breach, I would say breach would mean that a data has been compromised, while an incident could be one where there has been a penetration, but data has not been compromised. Now, there could also be several other, from a technical perspective, there could also be several attempts. Would an attempt be considered as an incident? In my view, no. See, if somebody is trying to break open a door and he is not able to break open that door, it would not amount to an incident at all. So therefore, it would only mean one where the door is broken open, but there is no theft because for whatever reason this person runs away. That would be considered as an incident. But where something is stolen, it would be considered as a breach. So I would say that incidents which require disclosure would be one where there has been a violation, but maybe there has been no loss. Breach where there has been a loss also. I must also add all these interpretations are my own and they're not to be taken as one of the organization that I represent or of the regulator. It's purely my own. Yeah. So there was some other question on Regulation 17(1)(b) carve out with respect to directors. Can you just read the question?
Regulation 17(1)D has carved out for financial sector regulator nominee to whom the reference is made here.
Yeah, so financial sector regulator, you do have, the RBI nominees also are appointed. In few cases, it could be RBI, it could be the NHB or any of these. So those are the ones who've been referred to in this particular provision.
There is one question which says KMP in which the LODR goes back to the definition in company. I don't know what exactly does.
Yes, of course. KMP definition will be as is defined in section 2, subsection 51. But at the same time, the ones which are relevant, like see, in Companies Act, you have section 2, subsection 51, which is, in my opinion, relevant only when the ministry is charging people as officers in default. So section 2, subsection 60 of Companies Act comes into play. Section 2, subsection 51 would be read very thoroughly in such cases. Otherwise, it will be 203, which will be referred to. So under 203, if you have a CEO or a managing director or a whole-time director or a manager or any other director on the board, so you will need to, the any other director comes into play only where 203 is not attracted and it is only for officer in default. Because if you have a CEO or a manager, that person need not be on the board, but he becomes a KMP under 203. And then you, of course, have the CS and the CFO. So appointment vacancy in the office of CS or CFO needs to be filled within a period of 3 months, which is what is also now covered in LODR, Regulation 26A. So, but with respect to compliance officer, there's a separate provision under Regulation 6.
So which means that there is a substantial enhancement in the position of a CS.
Yes. In fact, in terms of responsibility, there is a much more than substantive. So I think we need to be very, very conscious of these amendments and ensure that the processes are properly put in place.
In fact, I am tempted to suggest to ICSI, and they have various certification courses for various aspects. I think it is time now to have a certification course on LODR.
In fact, I would actually suggest certification course on Reg 30.
Reg 30, okay, that is still more, you are as granular as anybody can be. So with the result, I think Reg 30, that would be, I think, yes, probably yes, after this particular amendment. Yeah. But I think this certificate course on LODR could probably be a precondition to get appointed as for a listed company.
Absolutely.
So because the reason is that, like, we have this peer review, and those who are put in 5 years experience or 10 years experience for undertaking certain tasks, especially for practicing members, for employed persons who want to get into listed companies, they should have a certificate done on this LODR as a precondition to get listed companies, because this recent amendments to LODR, there is going to be heavy spotlight on the role and performance of CS in listed companies.
And to add to this, Anantha Subramaniam sir, the passing marks also should be higher on a later wing.
No, that I think we should. I'm no longer the president there, so with the
just as a matter of this thing, because
it could be, but the fact remains that now things have come to such a pass that especially for listed companies, there's LODR itself, and as Savithri says about Regulation 30 itself is an act for specialization. And it is high time that ICSI focuses its attention on ensuring that our members, whenever they get appointed And the number of companies, now I read about 10 companies are going public this month. So you can imagine every company will have a compliance officer. And obviously these sort of unraveling these mysteries which are there hidden behind these regulations is going to be quite tough. And it is in our own interest that we should place the bar straight, higher, so that we get the right people to do the right job. The SEBI has given enormous attention. In fact, I recently read, I have already sought ICSI's views on REIT and InvIT. There they are talking in terms of CS and also in terms of practicing CS for preparing some reports on this real estate investment trusts. So which means that that recognition, if I don't want to use the word recognition because those days are over. The giving the right role to the CS is now part of DNA of SEBI. SEBI knows exactly where to put in this, where to pull the CS. And to that extent, we should also set the bar high and ensure that we are equal to the task of this continuous identification and also continuous acknowledgement of the role which we play by the regulator. I hope Savithri Parekh agrees with my views.
I fully agree with your views. And in fact, I was very serious when I said Regulation 30, because you have Regulation 30, Regulation 23, and each of these are, separate courses in themselves, if you ask me.
That's what I'm saying.
It's like investment banking is very different from arranging for finance. And I think these provisions, I'm sure Shivram and Mr. Ved and all of you will also agree with me that each of these are very, very distinct. And, and also given the fact that in XBRL filing, there are far more things which are covered, covering all the circulars, ensuring that you have a combined reading of everything. It's actually become pretty humongous.
You are absolutely right. You are absolutely right, Savithri ji. And I must say that though Anand said that he is now no more the president of the institute, but the voice of this forum will certainly reach the ears of the institute. That I am very sure. That
anyway, that you will make it happen because you are based in Delhi.
Let's see. No, these days distances don't matter, but doesn't matter. We'll try to do it. At the same time, just one small thing I was wondering. As rightly said, Regulation 30 itself is a code in itself, a big, you can say, requirement. Now, take, for example, 2 to 5 criteria, threshold of this 2 to 5. Now, if it is a construction company and it bags a big contract today, okay. Now, the impact of this contract in terms of turnover and addition to net worth, etc., will take effect in 5 years. So I was just wondering, at what stage do you need this disclosure? When you bag a new contract at that stage, or every year when it adds to the turnover? These sort of questions may keep on coming, and I think one needs to find answer at a good time. I don't know. How do you react to this?
Sorry, your voice was not very, very clear, but from whatever little I understood is that, yes, you have to keep checking it year on year. The thresholds will keep changing year on year.
No, but this will be a unique situation. Supposing a company is already having a contract, it is in construction business, okay, right. Having a turnover of X amount. Now, today it has bagged a new contract. If you see the total value of the contract, it is, you can say, 50% of the present turnover. Right. Or present, but this contract will be executed over a period of 5 years.
Correct.
So threshold, how you will calculate, because the value of turnover of this particular contract will also keep on adding to that. So it is a complex process, in fact.
No, you're absolutely right. Let me, in fact, build on what you just said. At the time when you entered into the contract may not have been material. However, the cost overrun may have become material because the company may not be doing too well thereafter. So, with respect to the cost overrun, you are required to make a disclosure. Let me take another simple vanilla example. You've entered into a construction contract, which, let us say, did not require disclosure, but your execution is going to happen during the time. Now, what are you supposed to do? Is it to be considered as a continuing contract and therefore requiring disclosure? Here, I would say, at what stage are you going to recognize it in your top line? If the invoicing is going to happen later and you're going to recognize it in your top line at that juncture, then it requires disclosure because it will be considered as something which is continuing in nature. So that's the point. I mean, at what juncture have you paid your GST and because your top line will then be, disaggregated to see the stage at which you were required to make the disclosure. And I think it's pretty complex, and that's exactly the reason why one will have to see, because as you said, once it is signed and done, it's only the execution as to whether you bought steel and you've started the construction, mobilization. For example, what if the mobilization contract exceeds the threshold of 2%? Mobilization contract is just one small component of your larger one. Are you going to treat the entire thing as one big piece? You may have a mobilization agreement with one single party for several contracts, while each of the contracts may not otherwise require disclosure because they've been executed earlier and each of those contracts are small. But the mobilization contract is big because you've combined maybe 20 things together and have entered into this. I think these are all complex questions, and maybe a detailed line item by line item analysis will be called for. For
Yeah,
example,
totally.
in construction projects like L&Ts, where they have multiple agreements with multiple parties, maybe they have mobilization agreement only with one single party. I mean, not one, maybe 3, 4. So these points will become relevant there.
True. It will be a complex situation. Let's see. Let's see how it unfolds.
So add the pressure on the practicing professionals. It is not merely the compliance, but also to ensure compliance.
Absolutely.
To that extent, the practicing professionals also require some amount of compulsory training, certification in this LODR, and you said Regulation 30, because it is this capacity building is a misnomer here. There is no building capacity. It is building that relevant capacity building. What you require to do is to focus on that particular relevant capacity, so that people are equipped, because more and more companies get listed, so more and more secretarial audits, but the practicing professionals also have to be equal to the task.
True. Very true.
Absolutely. I think we have had an excellent interactive session. I'm sure, Savithri, you enjoyed as much as we enjoyed.
Absolutely.
Can Anandji, can I just raise one question to Savithri, if it's okay?
Yeah, please.
Hi, Savithri, thank you very much for the fantastic presentation and great analysis. I think, and coming from someone like you with the helm of Reliance is super for us. Do you think that something like this should require more time to implement? You see, it is not just about the cosmetic or small changes which are required. This requires a serious amount of judgment analysis. And this requires application of regulation, not the regulation per se, but the application of regulation per se with the operations of the company. And basis that, in my opinion, a detailed operating manual will have to be prepared. And that manual, as you rightly pointed out, will have to be socialized, have to be discussed, have to be understood, because at every level, there is so much of judgment required. And I believe that 30 days from the date of publication, I don't think is enough time for the companies to honestly operationalize this.
True. I mean, it's a tall task and a very heavy ask.
Yeah.
Is all that I can say.
I think it's honestly, I would suggest Anandji, and maybe the others also. I think we should certainly seek more time to implement, in my opinion, Savithri.
In fact, 30 days, we've already lost 15. So
yes, that's right.
Actually staring at another 13 days,
yeah.
Today and tomorrow being holiday, where I'm going to be worried.
Yeah. So no, I honestly think, Savithri, I mean, they give so much of
The
time.
the AGM season is on.
AGM season. No, that's the reason, Vishwanathan, that's the reason I raised this issue. Accordingly, because it is not just, it is about not a simple interpretation, no?
True.
It is about the operating style, if I can use that word, Savithri. It's an operating style of the company. Actually, listed company will have to undergo a change. How can you expect that to happen in 30 days?
No, but let me put it the other way. While it is tough, what I would suggest is prioritize. Look at each of these headings, prioritize as to what is required to be done today, and thereafter keep working on the timeline. So, that is the best way to pair it and ensure that you are geared. I mean, to start a marathon, I would never be able to run a marathon, but at least I'll try to run the first 500 meters, not at sprint speed, of course. So that's exactly the way we will have to disaggregate it and try to ensure that we are ready for it.
No, very well said, Savithri. But you don't see that chance, right? No one has written to, I don't know if has anyone written to SEBI to give some more time. I'm not sure.
They will tell you that this was discussed at the board meeting and everybody knew about it because the discussion paper, consultation paper was released in November 2022.
Yeah, but the consultation paper, I mean, most of the time, the changes, you don't know whether they'll get carried, they will not get carried. So
that's of course true, but they'll tell you that was the syllabus and this is just the question paper.
No, I appreciate that. I'm just discussing at this forum and with the fellow members, Savithri.
Yeah. No, I'm not for a moment saying that the time is sufficient, but I'm just saying that, very often you go to the examination hall and you feel wish few of the questions were different.
I think Subodh has raised an hand.
Yeah. Morning, ma'am. Subodh from L&T. One question on the orders only. It says awarding or bagging orders or contracts not in the normal course of business.
Right.
So the question is, what is not in the normal course of business here? Because companies like L&T, we keep on disclosing even the orders which are received in the ordinary course. We feel orders beyond a threshold also can impact the price in a way. So why the word not in the normal course of business is mentioned for both awarding as well as bagging?
Sure. So one is, should you disclose, should you not disclose? You have adopted a very good practice of just disclosing. Now, what is not in the normal course of business? Let's assume, a pharma company gets an order from Africa for supply of medicines. It would be considered to be normal course of business. However, getting a huge order for a vaccine which has been developed by them from let's say a developed country would certainly be considered as one which merits disclosure. Although one would actually say that it's in the normal course of business, but the fact that it was not otherwise expected is something which will have to be let's say, for example, they had not even registered themselves in that country, but now that they've got this order, they're going to be complying with all those requirements and completing the necessary formalities, would definitely be one where the price of this particular company would get pushed considerably. So therefore, they would say that this is something really big. Or for that matter, from a unknown quarter, you get a huge order, because orders, if you were to reduce it to the bare minimum, orders are always bound to be with respect to your business. You can't get a construction related order if you're not in the construction business. So when you say ordinary course of business, what is your revenue pie basically comprising of? If you've been doing B2B business and you get a huge order for a B2C kind of business, it would be considered as something which is a new segment, which was not in the ordinary course. So, or rather B2C and B2B would be considered as something which is not in the ordinary course. However, having said that, this is one where you're actually interpreting. You would say that, well, I've been working on this and therefore it is in the ordinary course of business only. But what is important is it creating a huge impact on your top line? If this news were to come out in public domain, will it lead to some kind of movement in the price? Or for that matter, let's look at it the other way around. If losing such an order be considered as something which is material. All of us are aware of an IT company which lost a huge order later, which happened almost about 12, 13 years ago, uh, did have an impact in the market. So, these kind of issues will have to be considered when you're looking at this.
Thank you, ma'am.
Yes, wait, I will be more. There'll be more questions.
Yeah, the topic is such that we'll have lots of questions and we don't have time.
Yeah, I mean, there's always some, has to be a closure at some point of time. But very interestingly, what I said, from being a principle based to a prescription based, these amendments also required a lot of contemplation, lot of reflection, lot of thinking, lot of right interpretations. So to that extent, it is not as prescriptive as what one would assume in the first instance, and it has made things lot more necessary for the application of the mind. Now, to that extent, grudgingly, I may welcome these regulations, because it is as much granular as it is also uh, giving a lot of efforts to the brain. So this uh, webinar, I'm sure, would have helped not only in terms of understanding and discerning the impact and the implications, but also set the ball rolling for all of us to put our thinking caps on, so that we don't merely comply for the sake of compliance, but we also ensure that we do the right way of compliance. I thank you wholeheartedly, Savithri, on behalf of all the participants and on behalf of SAGE, for this webinar. And then with probably on some other occasion, hopefully, SEBI will not, definitely SEBI is quite well known for keeping all of us engaged, and in some other forum, in some other format, we'll come back again. Thank you.
Thank you very much. It's really been a pleasure having this interactive session. My sincere thanks to each one of you. Thank you
And
very
let
much.
me also make this that this is the largest session SAGE has ever had.
Thank you. It's my privilege. Thank you very much.
Thank you.
Thank
Thank you all for participating. We'll come back again next month.
Thank you.
Next month or this month, 29 July. Special webinar. ಯಾರು ಅದು PG? No, internet.